Hi guys, today I want to discuss Alibaba's latest earnings as well as stock valuation. I have a long position on the stock for the 9988 Hong Kong ticker, and I've been holding the stock since its capitulation downwards from Ant's IPO. Before we start, please don't forget the financial disclosure. This is neither a buy nor sell recommendation on the stock, and I'm not a financial advisor, so please remember to do your own research. For Alibaba, I have a share price target of $163 on the stock, representing an upside of 51%. Alibaba's share price has swung wildly over the past few days. Following the video I did the other day on why Alibaba's share price has fallen to all-time lows, share prices of China internet companies rallied strongly following a report by the official Xinhua news agency that China will keep the stock market stable and support overseas share listing. The comprehensive statement also sought to resolve other woes that have plagued the market, particularly concerns over China's tech crackdown, saying that efforts to rectify internet platform companies should end soon. I believe the investment thesis for Alibaba is one that we are all familiar with. Baba is the leading internet company in China with a deeply discounted valuation, and despite slowing core commerce growth, its cloud business and other initiatives have a long runway ahead. Of course, we all know what the key risks are for the stock. Firstly, there's policy risks for Chinese regulators. There is the risk of delisting for Chinese ADRs on the US board. There's competition from other e-commerce platforms such as JD.com and Pinduoduo, to which Alibaba has been losing market share to. And lastly, earnings drag from new investments. For the valuation methodology I've used for this company, I've taken a DCF approach, assuming a revenue growth CAGR of 15% from FY21 to 26 and 6% from FY26 to 31. And I've assumed a terminal EBITDA margins of 19%, a WACC of 10.2%, and a terminal growth rate of 3%. Let's take a deeper look into its earnings report. Taking an overall look, 71% of the quarter's revenues came from China commerce, followed by cloud at 8% and international commerce at 7%. Cloud recorded the fastest growth of 20% year-on-year, followed by international commerce at 18% year-on-year and China commerce at only 7% year-on-year. As the company is reinvesting into growth, adjusted EBITDA decreased 27% year-on-year, and its EBITDA margins decreased from 27% in December 2020 to only 18% in December 2021. In the latest quarter, Baba's revenue from China's commerce retail business increased only 7%. In their press release, customer management revenue, which is the biggest contributor to segment revenues, decreased 1% year-on-year, primarily due to single-digit year-on-year growth in online physical goods GMV for Taobao and Tmall. They resulted from slowing market conditions as well as competition. Additionally, Baba increased merchant support through incentives to drive merchant adoption of new value-added services, as well as strategic reductions in selected service fees to lower merchants' operational expenses in a slowing consumption environment. This likely resulted in significant bearish sentiments in the stock, as investors were faced with an increasingly difficult consumption environment in China. Direct sales and others recorded strong growth of 21% year-on-year, reflecting a successful move into online groceries. Alibaba acquired 3.6 billion controlling stake in Sanat, one of China's largest big box and supermarket chains. This was a strategic move in its new retail strategy, which aims to integrate Sanat's physical retail locations into Alibaba's Tmall supermarket platform, and also ties in nicely with Baba's Ele.me and Cainiao, which are its on-demand food delivery app and logistics business. In terms of segment EBITDA, while adjusted EBITDA decreased by 20% year-on-year due to new initiatives, the company reported better sequential EBITDA margins, improving to 34% from 30% reported in the September quarter. However, we are also beginning to see some encouraging results from Taobao Deals and Taocaicai. Taobao Deals is a manufacturer-to-consumer model which gives shoppers bargain deals, while Taocaicai is a group buying initiative to catch up with Pinduoduo. Taobao Deals was a major contributor to new user acquisition, reaching 280 million annual active consumers, and its press release said that paid orders on Taobao Deals grew strongly at over 100% year-on-year. As for Taocaicai, over 50% of Taocaicai's annual active consumers were first-time fresh produce buyers on Baba's platform. GMV from Taocaicai also increased 30% quarter-on-quarter. Management also said that unit economics per order continues to improve, benefiting from higher regional order density and improving gross margins from enhanced supply chain capabilities. Management also suggested that the focus for Taobao Deals and Taobao will be shifting to quality growth, and operating losses are expected to narrow down in the next few quarters. For international commerce, order growth was up 25% year-on-year, with Lazada recording 52% year-on-year growth and Trendyol recording 49% year-on-year growth. Compared to Shopee's 90% increase in gross orders, it seems that Lazada is lagging behind. But it could also be because Lazada's baskets are mainly bigger ticket items. In addition, adjusted EBITDA loss increased as well, primarily attributable to the increase in Lazada's marketing and promotional spending for user acquisition and engagement. This is a worrying sign, as EBITDA margins should be increasing as the business scales up. Baba also says that it will continue to expand investments in international e-commerce as well as cloud, which is the next segment that we'll discuss. As for Baba's cloud business, revenue increased 20% year-on-year, and this was hit by a top cloud customer's decision to stop using its business and demand shift from certain sectors hit by regulations, such as online entertainment and education. However, there were positive signs of diversification, as non-internet industries now accounted for 52% of its total revenue. The revenue growth of Ali Cloud was disappointing and missed analyst estimates, but should show signs of improvement as the impact of the top client loss fades over the next few quarters. Ali Cloud is also operating in 25 regions globally, and higher domestic and international demand should help boost earnings as the cloud segment becomes profitable with scale. Management also kept up with repurchasing approximately 10.1 million ADS for approximately $1.4 billion, signaling an average price of $138 per ADS. I think that this is a great way to return value to shareholders, and shareholders could react positively if the company decides to upsize its buyback program. The company is actually well capitalized to do so, given that they have $46 billion of cash and $29 billion in short-term investments on their balance sheet. Lastly, let's look at the valuation of the company. For my DCF valuation, I've assumed a WACC of 10.2% and terminal growth rate of 3%. This is derived using a cost of equity of 11%, which I would consider normally too high for such a large internet giant. But it seems that regulatory risk and intensifying competition should prompt a higher discount rate. Growth-wise, I'm expecting revenue CAGRs of around 15% from 2021 through 2026, and 8% from 2026 to 2031 on the back of slowing economic growth. I'm expecting EBIT margins to be low for FY22 before turning higher as the company scales back on investments. Terminal EBIT margins are a question for investors, and I'm assuming 15%, which is higher than what Amazon has now at high single digits. It is unclear how profitable the cloud business will be. For CAPEX, I'm similarly assuming a higher CAPEX as a percentage of revenue before it scales back. With this, I've derived a value per share of $163, representing nearly 50% upside from today's prices. I think none of us are surprised that Baba is undervalued, and the main issues that overhang the stock are regulatory issues. The strict crackdown in the Chinese education sector is no doubt a warning to investors that Chinese regulators have a lot of power over markets. And even though Alibaba is a crown jewel in the internet sector, there's never a company that is too big to fail. However, I believe at current prices, the risk-reward profile is in favor of the stock, and I would definitely recommend a buy call on this one. That's all for today. Let me know what you think if you're holding Alibaba stock, and see you on the next video.